Hey everyone, I'm Jeremy Szafron, and this is Kitco News. Now, U.S. stocks have seen a slight downturn with energy and material sectors outperforming, but tech stocks lag behind here. Now, the latest spotlight is on the economic indicators, especially the producer price index, the PPI for February, which has taken a somewhat unexpected turn. Now, contrary to earlier predictions, the PPI rose by 0.6% month over month. It's a notable shift that's stirring more economic narrative here. A significant 4.4% surge in the energy sector has propelled this increase. Meanwhile, the core PPI, which excludes food and energy costs, saw a modest rise of 0.3%. So how might this influence the Federal Reserve's upcoming meetings? With the market previously anticipating multiple cut rates into 2024, these inflationary signals could prompt a reevaluation. Now, the shift raises questions about the Fed's next move and how they'll navigate these inflationary pressures. And as for gold, which has recently obviously seen some new highs and increased purchases by central banks, what do the economic developments mean for gold? With inflationary concerns back in the spotlight, the allure of gold as a hedge against inflation could be reinforced, potentially influencing its demand and, of course, its price trajectory. Now, joining us to break this all down is Will Rhind, founder and CEO of Granite Shares. Will, thanks for coming on and welcome to the show today.
Thank you, Jeremy. Great to be back on the show.
Yeah, excited to have you on. I mean, there's lots to get to. And firstly, let's get your thoughts on the PPI numbers just released. Anything surprise you here? I mean, higher for longer, it seems.
Yeah, not much surprised. I think the above expectation number down to rising commodity prices was not a big surprise to me or for folks that watch the commodity markets in a bit more detail. I think the Fed will still focus on the core number, which excludes food and energy. And clearly the market, although it's down today, still expects there to be a rate cut, a first rate cut in June. But those odds, the probability of that has come down a little bit today. I think it was in the 70s, 70%, yesterday, and is down to the high 60s today after the PPI.
How do you assess the risk of stagflation here? And, what strategies might investors consider in such a scenario? I mean, it's been really, really tricky for the Fed.
Yeah, it has. And I think that, the data overwhelmingly does point to inflation coming down. But clearly, if we get into a stagflationary environment or if inflation stays higher than expected for longer, then we know that from periods in the past, albeit we don't have a huge amount of economic data to support it, but assets such as precious metals, commodities, hard assets do well or can do well in that kind of environment. But I don't think we're there yet. I think we're still talking about rate cuts this year. These inflation numbers will fluctuate, but I think the core numbers are coming down.
Mm-hmm. The market's been so resilient, absorbing punches, and still seems to be ticking upwards. For someone looking at gold, as you just mentioned, how should they read into the resilience here? Is gold still a safe bet in a seemingly bullish market?
I think so. Look at how resilient gold has been, in the face of the highest interest rates that we've seen in some time in the market. Despite all of these pressures, we see gold making all-time highs. And so I think that shows you how strong the market is. I mean, gold, dips a little bit today, but not by much. And I think that shows that the dollar has weakened, allowing gold to strengthen in the back of, again, expectations around falling interest rates, real yields falling as well. And of course, let's not forget the geopolitical tensions around the world, which can escalate almost at any given point.
Yeah, no, there's so many going on. Should the Fed take a less aggressive stance than expected, might gold see a dip in interest as investors pivot to more yielding assets?
It's difficult really to think about, in my mind at least, the Fed being super aggressive in this kind of environment because, on the one hand, people are talking about interest rates coming down. I think some people have some fairly, outlandish expectations for interest rate cuts this year, but it's difficult to suggest that there's anything fundamentally wrong with the economy at this particular point in time. Rates are where they are, and of course there are impacts. There are pockets of the market, such as mortgages, housing market, which are feeling the pressure. But with the stock market at all-time highs, it's difficult to argue that we're in any kind of economic or bad economic situation. So I do think that we get a rate cut this year, but perhaps the surprise is that it won't be as many or as severe as some people think.
Yeah, we started out the year with expecting 8. That's what at least the market was pricing in. Currently around 3. Anything surprise you here? I mean, is America's resilience and has the economy surprised you? Has it been doing better than you expected?
I think actually, I've been saying this for the last sort of year and a half that I was not a believer in the sort of imminent recession narrative at the beginning of last year, which so many people were peddling. And, to my mind, it was just difficult to see that catalyst that would be the reason for a sudden sort of economic shock of any kind. That of course people will point to the housing market, people will point to other softer parts of the economy, but it wasn't enough. There were some forest fires in the banking sector with Silicon Valley Bank and things as rates tightened quickly, but they got put out and we moved on quite quickly. So I've not been surprised by the strength of the market so much as I think and we should point out that as tech, the large tech stocks were really the story of last year, have been the story of this year again. So it is a smaller number of companies, but I think there's evidence now that that's starting to broaden out beyond just these top mega tech cap tech stocks.
Yeah, the 7 that you're talking about, the Magnificent 7, and the S&P slowly coming down a little bit today. I'm curious, how do you view appeal of inflation-linked bonds compared to gold? Are we seeing a shift in preference for one or the other?
I don't think so. I mean, I think that if anything, we start to see more interest in gold at this point in time, because the narrative for this year, has been about falling yields, falling real yields. So the attractiveness of bonds just more broadly, one would think would wane a little bit as interest rates come down. And therefore, the attractiveness of a non-yield bearing asset like gold would increase. And I think as, the market continues to tip up, maybe that we see a little bit more volatility, but people start to think about, preservation of capital as well. And that's where gold also plays a role in a diversified portfolio.
Yeah, we're navigating an interesting year. Obviously, it's an election year. There's ongoing discussions about the debt crisis in America, and of course, a weakening U.S. dollar. I'm curious, how are these going to affect market volatility, in your opinion, and maybe some investor sentiment this year? Is it going to be a huge effect here?
I think that if you look back, and certainly in history, that I think the overwhelming view from the data is that when you have a U.S. presidential election year, that overwhelmingly is positive for the market. And subsequently, if the incumbent president gets elected, I think it's almost certain that the year after has been obviously a good year for the stock market. So the election year, I think, is something that people can look at the market, can expect perhaps to see some accommodative policy, and again, some of that is behind the reasoning for the Federal Reserve and others to start dropping interest rates. So, the market so far has performed well, but, it's not just about the presidential election. It has been, in my mind, a rally that's largely been built on fundamentals. And, not just the top, mega cap tech stocks, but starting to broaden out. Overwhelmingly, we have seen positive earnings, and that's what's driving the market.
Yeah, I mean, on the consumer side, though, we're seeing some consumers hold back some spending. Is there something to be said here? I mean, are we going to start to see the effect of this?
I think that we saw some weak results from some of the consumer stocks, and it's definitely going to be, a sort of case of the haves and have-nots, in retail. There are retail companies, consumer-based or consumer sector that will perform well in this kind of environment, and there are others that won't. But I think, again, the longer that these financial conditions continue to be tight, the more that will affect the consumer. It hasn't really so far, and that's, again, been a big reason why, the market's held up. That's why, the GDP numbers have still looked so positive. But there comes a point where, those pressures will, one would think, ultimately, land on the door of the consumer and will make, spending tighter, and hence, the cycle will come to an end.
Okay, so let's be a consumer here for a second, or at least a retail investor. How should you position your portfolio here? Give us a little bit about your forecast.
I think the retail investor or investors have been right to be long the market. That's been a trade that's continued from last year. Just being long pretty much any major equity index, U.S. equity index has done well, with the Nasdaq, being the best performer, followed by the S&P. But the smaller company sectors, the Russell 2000, there's evidence that now is starting to appreciate, and perhaps that the rally's broadening out beyond just the largest names into smaller companies as well. But I think the overwhelming evidence so far has been that it's an environment where most risk assets, if not all risk assets, are outperforming. It's an extraordinary situation where we have all-time highs in the stock market, all-time highs in gold, all-time highs in Bitcoin. And so I think the sentiment from an investor perspective right now has to be positive.
Yeah, it has to be positive, but is there any bearish sentiment that could happen here? I mean, are we too excited in the market?
Yeah, there's always a danger of that. There's always a danger that, when you see all-time highs in multiple asset classes, that, you're sort of closer to the top than anything else. But there's definitely reason to be cautious, of course, particularly around some of the euphorias we've seen in cryptocurrencies, for example. But again, overwhelmingly, the shocks could come from anywhere. But if there's a surprise with interest rate, and there's not the interest rate cuts that people expect, financial conditions continue to tighten, even inflation starts to tick up more than what we've just seen in one particular data print today, but inflation starts to rise again, that's a problem. And of course, the geopolitical situations that we have around the world can escalate again, causing issues for the global economy and for financial markets.
Yeah, Will, before I let you go here, I'm curious, going back to the gold side. I mean, we saw central banks, particularly in China, obviously, buy up a lot of gold last year and almost record amounts. We saw some ETF outflows. I'm curious, in a market like this, when investors are looking at gold spot prices as high as they are, is anyone looking towards ETF? Are you seeing some inflows here into the bigger market?
Yeah, we started to see some inflows again just in the last couple of weeks. And so, again, to me, that maybe we have to wait a little bit longer before we can call it a trend. But it shows some signs of life here that investors perhaps are a bit nervous about what's happening in the market, in certain areas of the market, and is starting to think about diversifying away from some of the gains that have been achieved in tech stocks and cryptocurrencies and other areas of the market. So, that has been, I think, for me, the weak spot in terms of not seeing that ETF demand come through in the way that we might have expected in a rally like this gold. But as that's sort of changed over the last couple of weeks, I think if that continues, that's a big positive for the gold market.
Yeah, and it seems like people are just waiting for these indications and data being released to see where they should position themselves too here. Will Rhind, founder and CEO of Granite Shares, joining us today. Will, thanks again for coming on and making the time and breaking this all down for us.
Jeremy, thank you so much for having me back on the show. Thank you.
Looking forward to it again. Appreciate it. And we appreciate you, the viewers, for tuning in. I'm Jeremy Szafron for Kitco News. Don't forget to subscribe to our channel for the latest breaking news and go to kitco.com for the latest.